Good morning, one and all present here. I am Dr.V.Deepha from the Department of Business Administration PG. Today we are going to discuss about the cost of capital under the chapter of Financial Management Unit 4 Overview. Agenda, cost of capital, concept and components, weighted average cost of capital, financial and leverage, operating leverage, capital structure and alternative financial plans, capital structure theories. Under cost of capital concept, minimum return required by investors on capital invested, reflect risk and opportunity cost of funds, used as discount rate in capital budgeting decision, determines project feasibility and company valuation. Components under the cost of capital, you have three components: cost of equity, cost of debt, cost of preference shares. Under cost of equity, return expected by shareholders, cost of debt, interest rate on borrowed funds, tax, cost of preference shares, fixed dividend rate paid to the preference shareholders. Under each component, weighted by market value proportion. Under weighted average cost of capital, it shows the overall cost of financing firm's asset, reflect risk profile of overall business, used as a hurdle rate of investment projects. Weighted marginal cost of capital, it shows the cost of incremental capital raised for the new investment, changes as more capital is raised, plotted against cumulative capital to show raising cost schedule, used to determine the optimal investment cutoff rate. Capital structure, mix of equity, debt and preference financing, determines financial risk and returns to equity holders, affects weighted average cost of capital and company valuation. Optimal structure balances cost and risk. Financial leverage, use of debt financing to magnify the equity returns, increase return on equity when earning before interest and tax greater than the cost of debt, amplifies losses in down returns. It will be measured by debt to equity ratio, debt to capital ratio. Next, operating leverage. It impact of fixed operating costs on earning before interest and tax changes. Higher fixed costs increases operating leverage, magnifies effect of sales changes on operating profit, measured by degree of operating leverage. Combined leverage, it is a combination of operating and financial leverage, a joint effect of fixed cost and debt financing. Degree of combined leverage equal to degree of leverage into degree of financial leverage. It shows total sensitivity of earning per share to sales changes. Higher combined leverage equal to higher risk. Analyzing alternative financial plans. Compare different capital structure impact of earning per share. Calculate earning before interest and tax minus earning per share break-even points for each plan. Assess financial risk under varying scenarios. Select plan balancing return and risk objectives. Capital structure theory, under you have the fourth theory. First, firm value independent of capital structure, there is a no tax. With tax benefit, debt increases firm value due to the tax shield. Trade-off theory, optimal structure balance tax benefit with cost. Picking order theory, firms prefer internal funds than debt and equity. Real world applications, project evaluation using companies under weighted average cost of capital as hurdle rate, merger and acquisition valuation, restructuring and refinancing decision, dividend policy determined based on capital needs. Under this PPT, we can see the summary. First, cost of capital at minimum return. Weighted average cost of capital integrate the cost of all finance sources. Leverage amplifies the returns and risk. Optimal capital structure balances benefits and costs. Theories guide capital structure theory. Thank you.